All right, good morning, everybody. It is CPI day, and it is also the Beige book. I talked about yesterday how the market has priced in a rate hike of 25 basis points with a plus 90% certainty. And they did that based on the Fed's word that they're not done and that they need to hike again. But the Fed is trapped. It can't really come out and say in advance that they're going to pause because that sentence has so much historic weight behind it that the markets are going to really react to it. So it's not that they're lying, it's just that they can't say it until they just surprise it. But they've made it clear over and over they don't like to do surprises. So how do we square this hole? Two things. One is through the CPI today. If the data comes in that gives them cover so that they can say, now we can pause, then it won't be too much of a surprise, right? The FOMC is on the 26th and it's only the 12th. So it'll be a little early, but not too bad. And then there's the Beige book. And the Beige book is going to probably carry them over the finish line for them to be able to say they're going to pause if there is an actual pause on the horizon. Analysts way smarter than me are still in the camp that we're absolutely going to pause and that there is no ambiguity or doubt or confusion in their mind that we're going to pause. Damn what the FedWatch tool says. They say we're going to pause. So if we are going to pause, then the data we get today will give the Fed the cover they need to announce that pause. But with that in mind, we got to think about how the market's going to react to it. Now, it's a little counterintuitive. You would think the markets would go up on the announcement of a pause, but it's the opposite. So once they do announce a pause, we're going down. That's the historical precedent, right? Nothing happens 100% guaranteed every time, all the time. But when history shows over and over that the market goes down after a Fed announces a pause, you kind of got to believe that the next time they announce a pause, we're going to go down. Buy the rumor, sell the news. Speaking of, if you've seen the S&P this morning, buy the rumor, sell the news. The market actually advanced. We can see around the world, global indices continued to advance throughout the night, and on light volume, no less. You know, that volume is really light this morning. So we've got Kashari and a couple other Fed speakers. We have auctions today, Bosick, we got the Beige book, and then we got Miser. Full house, I'm telling you, it is going to be a very busy day. And one thing that will just absolutely save your account is wait for it to get out of the range, right? We had a couple of really good trades yesterday. Not a whole lot. All we had to do is just, show a little bit of patience. Today, we've got the liquidity gap play. So I'm really hoping that we get that opportunity. I think we're going to get it. And we have the dollar lower. All right, I don't want to say it's a weak dollar. So if you look at FX Street, where it has this impact gauge, you can see that we've got a lot of hot topics today, right? So buckle up, ladies and gentlemen. It's going to be a bumpy ride. Right now, the volume is sitting at 70. If we didn't know that today was an economic event, and we just came in one morning and looked at the volume and seen it sitting at 70 for cumulative overnight volume, you would want to be concerned. You'd call timeout right there, go looking through the news, try to find out why it's so light. We already know why it's light, so it's not a big deal. It's not a surprise. It's expected and anticipated, so it's not a problem. But that's why we look at it, because if it was an unknown, it would be a dangerous unknown. We'd really want to know, hey, why is the volume so light? We do have a market maker move today. This implies hedging and a lot of it. So market maker move is something that Thinkorswim invented way back in the day. Tom Sosnoff owned it. And what it basically comes down to is that the front expiration here in the options chain has a higher implied volatility average than the next series out. And we can see that right now, the front has a 17.6, 17.16. And the next series out is a 15.62. So the front one is higher than the back one, and that means we will get a market maker move, which we have right there. Now they do it in dollars. I like it in percentages. So I wrote this little label here to give me both. It shows me the percentages and it shows me the dollar value of how far it could go up or down, right? It's a plus or minus. It's not a single direction tool. We take that market maker move and we add it to the 21-day average. You know, like what is the average daily movement for the S&P? It's around 1%. So we take that 1% plus that 0.5%. I'm doing a little rounding there. And we get about a 1.5%. But that's projected. We haven't even reached yet. And it's not from the close, it's from where we're at right this second. So we could go 1.5% higher or lower from our current location. All right, so that's not too bad, right? But again, I ain't reaching yet. So if today gets a little exciting, we get a little rowdy, we will double that 1.5%, a 3% move. It's not unheard of. The S&P has made 10% moves. It's made 9% moves. It triggers lock limits and, you know, they freeze everything, but oh yeah, we can move. So a 3% move, nah, it's nothing. But you do want to kind of consider where that would put us. Now, you also have to consider that half of the trading day is already done. And usually when I say that, I get some feedback from a new guy who says, what are you talking about? Half the day is already done. The bell hasn't even rang yet. The day hasn't started. Yeah, it started last night at 6 o'clock p.m. We are past 6 o'clock a.m. now. That's half of a 24-hour period. Half the day is already done. This wee little bit of trading from 9:30 to 4 is wrapping up the day, right? So we're talking about moving 3.5% in this small window of time between 8:30 when CPI kicks off and 4 o'clock. What would it look like? It would look something like this, where we have these outsized one-time framing single direction candles until we V or we top out and drop, right? Something like that. Or maybe over here where it's just, you know, single direction, one-time framing, no pullback, just a straight rip, run hard and fast. Up or down, I'm not biased in this. There's no reason to try to assume which direction we're going to go before it starts to go there. CPI, even in the number itself, isn't even going to be the issue, right? It's how the market perceives the CPI number. Are they surprised or not? Are they caught off guard? Do they believe that the CPI number is now going to give the Fed the cover that they need to announce a pause? Those are the things that we really have to think about, because they're what the market is going to respond to. If we were to look at the implied volatility here on the front series, this 0 day, it says $33.37 is the IV expected range with a 1 standard deviation. And we could use that number and then add the $20 here, and that would give us about $53 higher or lower, which is $106 end to end. Still, that's not too bad. But still, again, when you use this number, you want to know what rowdy looks like, multiply it by 3. So not a $100 range, a $300 range. And gosh, wouldn't you know, that gets us right back to that $300 that we were talking about. 150 higher, 150 lower, $300 range. It's always great when your data gives you the same answer, especially when your data comes from different sources. That way you avoid multicollinearity. Yeah, that's a big word first thing in the morning. 10-day, 30-minute volume profile. When we're at the lows, we go to the highs. When we're at the highs, we go to the lows. By tomorrow, unless we go down today, it's very likely that this low here at that 44.10 is going to be the low. It'll have this white line and the little yellow line, and it'll be the low. And it will look like we came down and tagged that line and we went up, just like it looks like we tagged this line here and went down. But we know that's not what happened, right? We do have an air pocket here. It's not as shallow as it used to be. We've built it up quite a bit. This is a more shallow air pocket, right? But we'd have to get below 44.11 to see that. By the end of the day, though, we should have more of a classic B shape profile, because we will have lost that third leg, right? This part here will be gone unless we come down and break it. So we'll have a classic B, and we'll go with that. Earlier this morning, we tagged the VPOC line, and now we finally made it through there. That was from back here. So I'm just going to go ahead and steal that line because we don't need it anymore. And I'm going to bring it over to yesterday's because it needs to be marked. It's still an untouched point of control. Recycle and reuse, right? Yeah, you like it. That was a significant amount of volume here in that little window of time. I should just leave this since I keep putting it back on there. Ah, that wasn't too bad. All right, so let's talk about liquidity vacuums. I seem to do this every time we've got CPI and non-farm payrolls, but I think it's worth it. So we got to give Thinkorswim a moment. I asked it for a lot. I'm not moving the chart right now. It's moving on its own. So once it quits moving, then I'll do my thing. I told it to show me a lot of days on a 5-minute, and so it's working the data right now. There's no reason for me to fight it. If you notice, it's kind of subtle in the chart on the right that I have almost squished that you can't barely see. It continues to show my mouse moving from new week to new week. to new week, one at a time. And again, that's not me. I'm just waiting on Thinkorswim. You use this platform enough, you learn to the little nuances with it, right? All right, it's done. Finally. Take your time, sweetheart. Okay. So that got us all the way back to March 2nd. And so we can just look at March 10, we had non-farm payrolls, or March 14, which is when we had CPI. All right, so there's the 10th. That's not too bad. It's not a great example. That we'll use this candle for what we don't want to see. All right. It's got a long wick on the bottom. It ended up driving to the upside, topping pattern within that range, and then it came back down and it closed the gap even before the bell rang. So that was an event and a liquidity gap, and the gap was closed very early, very fast. And the candle was an outsized candle in both directions. We don't want that, right? So when we're thinking about what we want to see today for this CPI liquidity gap play, that's not it, right? So that was the 10th. We'll just scroll on over here to the 14th. This is absolutely what we don't want to see, right? So at 8:30, when we get CPI, if we get one of these massive big bars like this, it's not what we want. Just throw the whole strategy right out the window if we get something that looks like that, because that's junk. We don't want that. So April 7 is the next non-farm payroll day. All right, that's a little bit better. A little bit of tail on the bottom. A good sized tail across the top. Everything stayed range bound inside that first candle, and it spent a considerable amount of time working its way back down to this gap close, 41.71. And I get it. You don't see a gap, right? I understand that. The deal is, though, that there is a gap. It's a liquidity gap. Now, this was on a day, it was on a Friday that the market was closed, but the data still came in, right? So that's why you're not seeing anything here. It was a Friday and there just wasn't any data. But that big candle in a single direction push, not much of a wick on the bottom, that's what we're looking for, right? Something akin to that. So this was the 7th, and that was non-farm payroll, but we have April 12th for the CPI. So we'll just roll over to the 12th right there. That's the first of one of our better examples. No wick on the bottom. I mean, a tiny little nubby, right? A poquito. Just a little bit. Hard drive to the upside. Finished very, very close to the top of the candle. And then it spent the rest of the morning, almost until lunch, trying to get that gap closed. And here's something a little interesting. I still haven't figured out what I want to do with it yet, but we tend to overshoot with a measured move. So this little shot down here, in all the examples that I'm going to show today that has this gap close, every one of them came back, closed the gap, and then overshot it. Like it was just trapping the bears there. But if it was a bear trap, it wasn't very good because it didn't get the follow through, right? And we ended up dumping right back down again anyways. So I don't know. I don't know what I want to do with it yet. It's still a tradable opportunity, knowing that it's going to dump past that zone. I like it. So this is a textbook classic picture perfect example of what we're looking for today. And it doesn't have to go up. So just to be clear, these gap close plays can go long or short. but you don't want you don't want any ambiguity, no doubt, no confusion, no hesitation. You want a very clean, solid signal. And if it's not that, the sloppier the signal, the sloppier the outcome. So as soon as we get CPI candle, you throw a line there, just shoot that line across the chart for the day, and then identify where the close is. A lot of times, once that candle closes, we'll print a couple more. Maybe we'll go higher, go a little wider, start getting a megaphone pattern up there, or we'll start basing up here. So don't try to trade it as soon as the first candle closes. I've seen multiple examples now of people trying to do this gap close. As soon as the candle closes, they're jumping in that thing. Hey, time out. One, trading between 8:30 and 9:30, that's just a bad idea. You got bonds opening up, the dollar opening up. You got economic events like this, CPI, but there's other economic events that come through that you don't even know what's going on, right? It could be grain reports out of New York, could be a million different things. Not all the economic events are posted. Some of them are so typically boring that they don't catch news, but that don't mean they don't move markets. So just trading between 8:30 and 9:30 is a bad idea. I'm not saying you shouldn't do it or you can't do it, but if you're struggling to make money already, quit doing that and you won't struggle so bad. So let that thing get into the open. You already know where the destination is, right? So it's not like you got to jump in that thing way up here. So that's the example of what we're looking for. That's exactly what we want to see. So I've given you an example of what bad looks like, and I've given you an example now of what good looks like. So you got a pretty good idea of what's on the table for today. This really feels like buy the rumor, sell the news. Really, because we're supposed to be range bound right now. Kind of keep that in mind, right? I mean, we're only up 0.25%, so it's not like we're up a lot, but we shouldn't be up at all. And this move was done on light volume. So, I mean, we don't have no trust to it. We do have an MDP, that's a missed daily pivot. And we're getting really close to the previous week's high. So now we really want to consider legacy zones. That'd be your gamma spots like 4450, 4400, 4100, 4150. Those are gamma points, legacy zones, psychological levels. They matter, right? And they're also going to be targets for 0-day traders. You know, those kind of like YOLO plays, and pinning to one of those levels is usually what happens when we get one of those driver days, right? We'll go right to that level. One of those days where we just keep running and running and running, and you think it's got to stop and it doesn't, and it just keeps going and going and going. We are 2.86% above the 10-week moving average. If we go down today, that is my target, the 10-week moving average. I think we can easily move 2.86% today with the with everything that's stacked up on the table. We are getting really close to the weekly expected move. Just remember the hand-drawn lines are typically more accurate, but close is close enough, especially when you're dealing with a $4,500 product. That line lines up really well with this structure back here. So it's going to have some resistance, and it's also a level 4492 that it's not a cog line necessarily, but it is a memory level. It's got a lot of weight to it. If you were to mark 4492 and look back, not just right in here, but you know, take your chart out to a year, maybe a 2-year, and you'll see how when you look left, there was an interactions at 44.92. Look at it on the quarterly, the monthly, the weekly, you'll see it. It stands out. So that's a big level anyways. Should we get through that today, there's a very simple measured move. We can just take this high and take that low. And if we were to measure that high and low and then project it upwards, 50% gives us 45.62. 100% of that measured move gives us 46.27 today. It's crazy, right? So we're finally getting that breakout in energy. You can see the range that we've had for so long with energy. And we're finally giving it a run, like we're going to break out of that sucker finally. It's on the move, right? But that is the 200 period moving average overhead. And it's still a very weak, nasty market. If we were looking at all of the designs that would tell us that this is a good, strong market, then price would be above the 50 and the 200, and the 50 would be above the 200. And that's not what we have. Plus, the white dotted line very clearly shows a 45-degree angle to the downside. And I mean, I know that's not perfect 45, but come on. I'm not a Canadian engineer, so I don't care. Close enough. 5-day change, 2.27%. For a slow, sleepy sector ETF like the XLE, that's a pretty good size move. Yeah, you like it. For a little bit of that capital rotation, this is staples. We're still struggling to turn things around here, but the white dotted line is starting to slowly turn up. We're getting these higher lows. We're just struggling with trying to get some higher highs, right? So we really want to keep our eye on this one, see how it's going to digest through this 200 period moving average. The low down here needs to stick, right? So maybe we retest it, but on a weekly basis, I don't want to see it close below this level. If we're going to continue to see this, you know, this picture of health. Yeah. All right, earnings season kicks off this Friday with banks. Banks usually set the tone for the quarter. So if the banks suck, it's a pretty strong opinion that everything else is going to suck for its earnings. Not every single company, right? But to average them all in. So we're breaking out here. It's really trying since the the crisis that we had earlier in the year, right? It's continuing to work its way back up. We'll have more by Monday, right? Because the banks are going to start on Friday. We want to see how that weekly candle closes and then look at the new week on how we open next week. Because not all the banks are going to report Friday, just some of the biggest ones. And of course, technology. There hasn't been any doubt, right, since January of how things are going in the tech space. There is the NASDAQ rebalance coming up. They're going to be rebalancing not just Apple and Microsoft, but quite a few other names as well. And it's a hot topic. I mean, I've read a lot from analysts on both sides of the fence. Half the analysts have said, so what? It's nothing. Don't worry about it. And the other half has said, oh, that's going to have some impact. So I don't know. There's no consensus on this one. And we've never had a company with the market cap like Apple, right? So I mean, it's uncharted territory. I have no idea. Someone that I know and really trust says that it's a negative for the NASDAQ and that it's going to weigh us down some. But for how long? All right. It's not like it lasts forever. Nothing does. So short-term weakness in the NASDAQ and in the tech space until it isn't anymore. And we're no longer weak again, and up we go. It's not like they're going to sell their Apple, right? They're not going to sell their Microsoft. Those institutions, Apple and Microsoft is the market. They're not dumping that. And if they did sell their Apple and their Microsoft, why would they buy anything else? Because if you're not willing to own those, there's no reason for you to own anything else. And of course, consumer discretionary, which is basically Tesla. A picture of health, 50 over the 200, price over both, linear regression line, perfect slant to the upside, continuous higher highs and higher lows. I mean, that's textbook. It doesn't get any better than that. Why am I going through this? Well, I mean, we need to look at it once in a while, kind of get an idea of, how things are going. But also, there's no reason to try to discern which direction we're going to go here. We need the CPI data, and then we're going to have a trading day. So, trying to look at the hot list today and seeing, what's up, what's down, none of it's going to matter once CPI hits. And that's why I didn't bother to come over and look at it. Like, oh, look at Google. Why? It's not going to matter. CPI is going to matter, and then it's going to move Google or Netflix or app, whatever. So with that in mind, everybody, be careful, be safe, watch the clock. There's a lot of things on the table today besides CPI, even though that's going to be the biggest driver right off the bat. And I will see you all tomorrow.